The Money Show.
Personal Finance with Warren Ingram.
And of course, Warren's a certified financial planner at Galileo Capital. 23 minutes now to 8 the time. And Warren, you picked a fascinating topic, actually, some lessons from 2025. And I've been saying all night, I think this is important because I think the volatile ride of 2025 obviously continues. And I suspect in some ways, if you look at how we've started 2026, it could be worse. Good evening. How are you doing?
I hope it's not worse, Stephen, but unfortunately, I think you're right. I'm doing very well, thank you.
Okay, so where do we start? And I mean, there's a fundamental point that you make, which actually is something that I find fascinating, which is that if markets are all about sentiment, bad news doesn't actually mean the markets will drop. And last year is the perfect example of that.
Yeah, I think it's one of those things where we so focused on, and I'm not saying it as a critique, but as human beings, we focus on the human stories and the human cost of things like the conflicts in the Middle East and in the Ukraine. And often we develop a baseline of negativity where we say, well, those kinds of conflicts, I mean, they're horrific, and therefore they must be bad for investment markets. And if that was true, the headlines would dictate the market moves a lot more than they do. And I think, just to understand, markets are affected by conflicts, but they would immediately start calculating. So, we just look at the start of this year. Trump installs himself as president of Venezuela.
Yes.
The market doesn't just get stuck on that sort of dramatic headline. What the market does is say, well, how big is Venezuela in the oil market? And it's less than 1%. What's their ability to deliver a lot more oil to the rest of the world? It's very limited. So actually, the price of oil is not going to drop dramatically because there's a change of leadership and someone who just wants to drill, baby, drill. And so the markets tend to do a lot more cold calculations and almost, not that investors ignore the human cost of bad news. They just calculate it, and in a very sometimes very cold, calculating way.
Just a reminder, the personal finance feature is brought to you by Sanlam Corporate. They take employee benefits personally because when you care, everyone benefits. Sanlam Corporate. One of the things about this, Warren, I suppose, is that we mustn't forget that markets also move in cycles. We're in the middle of a sort of AI cycle at the moment, and that's boosted the US, and we're in the middle of a gold cycle at the moment, and that's boosted us. So all of the bad news is not quite that the events are not as important as the cycle. Is that one of the lessons from this?
I think so, and I think also understanding where the future goes. So let's look at something like the AI cycle. It's it caused a massive run up, actually in the year before last year, and so investors carried on pushing certain companies a lot through 2025 as well. But at some point, investors started to look around and say, where else can I find opportunities, and what other markets will present us with future growth? And so, yesterday's winner might not be tomorrow's winner. And I think that's one thing that started to happen. And secondly, very big economic cycles like rising or falling interest rates tend to, especially in a very big economy, those tend to overwhelm the news cycle a little bit. So if there is a prospect that interest rates will continue to decline, then that will be a very big factor for investors because the cost of borrowing goes down, the ability to invest in shares with the prospect that you'll do a lot better than cash generally rears its head, and so investors start to do better calculations in favor of shares and fewer calculations in favor of cash. And the same would apply to the bond market. And I think last year was the year where we saw the resurgence of emerging markets for quite some time. Certainly I remember myself saying this over the last few years. We've looked at emerging markets saying that they're cheap, they're offering good value, and they didn't attract a flow of money. But when the dollar started to weaken, interest rates in America were going down, it started to move money away from the US into emerging markets. and that's another very big trend. And I don't think that flips from one day to the next. That's something that could become a bigger cycle over a few years, or certainly not days or weeks.
I suppose the other question is to ask what matters and what doesn't. So we saw almost the near collapse of the National Coalition over the budget last year, but that was completely offset by what was happening in gold. I mean, look at how our markets did.
I suspect that if that GNU had failed, and we'd seen a different coalition running the country, shortly thereafter, that we would have taken quite a lot of pain, at least in the currency market, and as you say, that would have caused the rand to take a little bit of pain, and then that would have been offset by very strong commodities again. So I think it's when things are going for you, it's good to take advantage, but we could have shot ourselves in the foot last year, and very fortunately we didn't. And we actually saw that in a few areas, because we also saw the South African bond market doing very well, and so it wasn't just shares. It was also the bond market, and interestingly, towards the second half of the year, even financials did well. It wasn't just resources shares, and South African industrial businesses, which have really lagged the market for a very long time, started. I think they ended up. I can't remember 100%, but I think it was round about that 10 to 15% for the year. So we actually had quite a broad uplift in the JSE, and certainly I don't think many people would have sat on the 1st of January 2025 predicting anything like that.
I suppose the other issue, and I mean, I find it interesting what I've been told in the past and what I know now. And in the past, so many people older than me told me two things. The one was buy a home in Joburg because it'll only increase in value, and the other was that you should get as much money as you can offshore. And I've come to learn both of those things were not good. Were bad choices. I didn't make the second, but the first I did.
Yeah, and I think let's give it a little bit of context. The rand against the dollar, hit the current levels that we're seeing. The last time we were there was somewhere around 2015. So it just around about a decade ago. And I can remember a lot of people, some very prominent commentators, in fact, urging South Africans to cash in their retirement funds, their retirement annuities or provident funds, if they could, pay the tax, so give away 45% to SARS, and send your money overseas. And for a while, that seemed like a decent decision, but now with the benefit of the cycle changing, what we're seeing is the rand recovering enormously, but equally the JSE and the bond market delivering very good returns. And I think it should paint a really sort of powerful picture and create a very strong lesson that I think we must learn is, binary investment decisions where you say all or nothing, all offshore, or all in South Africa. Those are both really bad decisions. And I think, we should hold people to account when they push an agenda rather than, kind of deliver sensible information. One is you don't know what's going to happen. You and I sitting here, we can speculate and prognosticate about the future. But the truth is we should start every conversation with, we have absolutely no idea what's going to happen in the next decade. And when you don't know what you're going to do, then making very big decisions like all offshore is really a poor idea. And I just did a quick stat and saw that the average global unit trust that invests in global shares, when you measure it in rands over the last year, did only, and I keep updating it as I get more data, but I think it's delivered about 6% for 2025. When you compare that to the average unit trust that invests in the JSE last year, 28%. And the correct criticism will be that I'm choosing 1 year, and 1 year is no investment thesis. But when you look at the average balanced unit trust in South Africa over 20 years has delivered just about 10%. And you measure the global balanced unit trusts measured in rands again, So you get all the currency depreciation, all of that locked in, and the return is 10.1. In other words, the difference is pretty much immaterial. So investors making these very big decisions and believing that South Africa or the rand or emerging markets are in a one-way bet are really suffering right now. And I think that's the lesson here is if you're an AI investor and you think NVIDIA is the only way to go for the next decade, you need to learn this lesson right now is it cannot do that. It cannot repeat this performance for the future. It already is yesterday's winner. You need to be worrying about other investments and finding new ways to grow your capital.
I mean, part of this is also the historic changes we're living through. I mean, some of this is about how the dollar has devalued against the rand, essentially. Yes, the rand's a bit stronger against other currencies too. But that also just shows you that you really can't predict what's going to happen because that goes counter to what everyone told us for so long.
Exactly. I mean, I can remember working on the average. The average was the rand depreciated against the dollar by about 6% a year. And that wasn't a forecast. That's just simply what happened. And so, often when you tell people that, they would be quite surprised, because they felt it was a lot worse and they, it was very emotive, that seems wrong or doesn't feel right. My gut says something else, but you can't rely on your gut. You've got to look at the numbers. And so when the rand strengthens by nearly 14%, in 1 year against the dollar, that's 2 years of recovery just in that one very short space of time. And as you say, it didn't do much against the rand, didn't do much against the euro and the Oz dollar and the pound. And so it is very much a dollar story. And, that's certainly Trump's economic strategy at play. That's what he wanted, was a weak dollar. And if that continues, it's going to be very positive for emerging markets. But again, we don't know that strategy works, as Trump wants it to in the next 24 months. Maybe things go in a different direction and the dollar actually strengthens. So I feel it's one of those times where looking at global markets is not a bad idea. The fact that the JSE, I think the JSE, when you measure it in dollar terms, delivered way more than 50% last year, and that's phenomenal. And there's certainly a good chance that the JSE, because it's not expensive, it can continue delivering in rands. I don't know what it will do in dollar terms, but don't now throw out all the overseas investments because they had a bad year or two. You've got to be very careful that the tide can swing again.
We're speaking to Warren Ingram, the co-founder at Galileo Capital and a certified financial planner, looking at the lessons we learnt in 2025. We have a question from Chris. Warren saying, I'm 24. I just started my first corporate job, earning 25,000 Rand a month. Where should I even begin with saving and investing? Getting in the ground floor is Chris. Warren, we had a question from Chris saying, I'm 24. I just started my first job. I'm earning 25,000 Rand a month. Where should I even begin with saving and investing? A person after your own heart, I think.
I love it. It just makes me so happy to get a question like this. And I want to say to Chris, before you get that first salary and you get used to spending all that money that will arrive in your bank account, you should aim to spend, or let's say go the other way around. You should aim to save around a third of that salary every month. So if you're earning 25 and we round up that third, it's roughly about 8,400 Rand a month. So the first thing I would do if I were you is take that 8,400 and start putting it into some kind of a money market account or something linked to your banking profile where you can start building up your emergency fund. So you want to try and get that to around 3 months worth of your expenses. So hopefully your expenses are going to be very low. And once you're at 3 months worth of expenses, then start looking at your tax-free savings account. I think that's such a fantastic investment for young people to maximize. So try and do your 36,000 Rand a year that you're allowed. And then, with the balance, try and start building up your retirement savings as you can. So for me, I would try and blend, tax-free savings, a retirement saving, and maybe a unit trust as well, just for some accessible money when you need to buy a house one day against the advice of some people, and maybe replace a car every now and then. So I think that's a good deal. But number one, try and save a third of everything you earn from the very beginning, so you don't have to take the sacrifices later.
It's very interesting advice, and of course I should have known it would start with the emergency fund. That makes complete sense. Back to some of the lessons of 2025, and I mean, you know, when you look at cash, I mean, cash would really not be the place to have put money last year, despite everything that was happening.
Yeah, and the reason why I want to talk about cash is because it gives us that very stable, predictable return. So whether money market funds last year generated about 7% as an average. Now, it feels like a good return when maybe not in comparison to shares, especially not last year, but we're starting 26 and we're really worried about all the volatility, and people are saying that the tech shares are too expensive, and the geopolitics was really wild. And when there's so much volatility, one of the things that we do as human nature is we try and find sort of a stable harbor somewhere, like a port in the storm. And so often that the temptation is to go and store your money in somewhere stable and predictable. And so looking at 7%, if you're worried that you might lose 30%, it looks like a good deal. But unfortunately, you pay away a chunk of your interest that you earn every year to the tax man, and you have to look at inflation. And so I think when you take off, whether it's 45 or 30% in tax, and you take off inflation, you're probably earning around 1 or 2% a year after all of that's gone. And you contrast that with the stock market, and especially in a year like last year, you're doing way more than 15% after taxes and inflation. And so you have to get ready now to embrace this kind of craziness and volatility that we're going to live with for quite some time. And I think we're going to live with volatility both in South Africa and globally. And we should now get to the point of saying that's normal, and not overweight the idea of stability in our investments and hoping that will be protection. I think stable investments actually almost guarantee that you won't beat inflation over long periods of time. So unfortunately, riding the volatility of markets and making sure that you properly spread across local, global, cash, bonds, property, shares, is probably your best antidote to all the craziness that's sure to happen in the next 12, 24, 36 months.
Does that mean we need to pay a bit more attention to our investments, or does it mean that we need to have the right strategy and stick to the right strategy?
Yeah, I would say actually, once you've got your asset mix correct and you've got the balance between local and global investments, I would actually stop focusing on them so much. We tend to watch our investments a lot more when we're worried about the world, and that causes us to become overly emotional, and high levels of emotion are very destructive to sensible investment decision making. So you actually want to look at your investments much less frequently than you would have in the past. And when the news is bad and you've got a good spread and a good allocation and the correct strategy, then the idea is focus on other things that that impact your life and have meaning and purpose and all of those things. But watching your investments is not going to add value at all, and in fact probably raises your blood pressure levels and anxiety levels, and that might force you to make a bad decision. So sometimes a little bit of almost temporary ignorance is going to be bliss, and could actually be a superpower in the next 1 or 2 years.
Sure, so long as you've planned for it, I suppose. And what's the phrase? Diversify, I suppose, would be the thing you'd need to do. Warren Ingram.
Correct, Stephen.
Warren Ingram, thanks so much. Really do appreciate it. And of course, a certified financial planner and co-founder at Galileo Capital. Business decision makers, this one's for you. Sanlam Corporate's Insurance Solutions helps you protect the people behind every payslip. Income protection, disability and life cover that keep households steady when life turns. They make it simple to recommend and easy to implement, so you can focus on care, not admin, because when you care, everyone benefits. Visit sanlamcorporate.co.za to partner with a team that treats employee protection personally. Build an age of confidence together.